You're watching Masters in Trading Live with Jonathan Rose.
Hey guys, it's Jonathan Rose and welcome to Masters in Trading Live. At Masters in Trading Live, I get on here every day the market's open, 11 a.m. Eastern Time, share some thoughts, go over the market once in a while. We'll share our trade of the day. So I've been in Chicago since 97. It's when I graduated university. For my entire career, I've been a trader. Okay, that's the only thing that I've done. I've worked at the Chicago Mercantile Exchange, Chicago Board of Trade, the Options Exchange. I've traded futures, I've traded options, pretty much about everything. The only thing I haven't traded, I've never traded currencies, but everything else, I'm pretty sure I've traded. So today, we're gonna go over the big money tell. We have our new Masters in Trading Challenge that I'm gonna talk about a little bit. We're talking about Oracle. Oracle's super strong. And then at the end, for everybody in our all access, we're gonna go over some of our open positions. So let me start right now. Let's head over to the screen and let's have some fun. All right, I'm going to start here because this is really exciting. Really cool comment yesterday. Just want to say that today's live video, so he's talking about yesterday, have been bang on the money, excuse the pun, super concise, informative, easy to follow, and tied back to the concepts well. A lot of great feedback on yesterday's video, guys. Yesterday's video, we talked about that very, very famous Wayne Gretzky quote, where he says you want to skate to the puck where it's going, not where it's been. And I argued that traders instead want to be more reactionary. Rather than go and skate to where the puck is, we want to see what's moving. Gold's really strong. What's that pulling? Gold strong? Maybe silver's a good buy. So watch that video, a different perspective than many people have been taught, but it gets us away from the speculating and guessing and crossing our fingers and hoping positions work. When you tie something down, we call it divergence or a pair trade. When one thing moves, we want to see what the other asset is doing. So Snowman, Kate, thank you for the awesome feedback from yesterday's video. And Roger as well. I always appreciate your personal involvement in our questions, our development. For 2.5 months of involvement with MIT, it's been a great investment. So Roger, thanks, buddy. I really appreciate that. Here's something that we've been working on for the last 6 months. And I want to take a moment to talk about this because I'm super proud of it. We ran the Masters in Trading Challenge back in November. And it's a 7-day course to take anybody from having no options experience to getting comfortable trading options. We did that with 200 people in November. It was awesome. We took all the feedback and then we redid every single video because we wanted to make sure all your feedback was heard, and we just released the new video. It's called The Big Money Tell. So I encourage you guys, please go watch it. This teaches exactly how I trade options, what I learned in 2011 from the floor of the Chicago Board Options Exchange, and how we trade options up to today. So again, masterthintrading.com/challenge 2025. This is brand spanking new. So go check it out. I think you guys will really like it. Tressa just finished day 1. Looking forward to the challenge. Learning how to value options and how to determine when to exit is worth a lot more than the cost of this challenge. Tressa, thanks for sharing that again, guys. masterthintrading.com/challenge 2025. Get in there. We'll see you guys in the Discord once you get in there. All right, let's get to it. We had another big winner, Oracle. Oracle's cloud business is doing really well. I want to take these next 2 examples to show you in Masters in Trading how we trade longer term holdings, because Oracle is one of those a little bit longer term holding for us. We got in this trade in March. So let me explain what we did right here. Got in the trade in March, right here. Not the best level, right? Kind of an okay level. 150. It got down and went against us. April, there was a lot of volatility. The market got hit, right? What we don't want to do is stop ourselves out. So what we did is the original trade, we buy Oracle, but what we're also doing is we're selling upside calls. We sold upside calls at 185 that expired in May. So we're long the stock, but we're also selling the stock in order to take in income. And that's what we did right here, selling the 185 calls. Those expired. We're able to collect that capital. That gave us patience to hold. And now we took off Oracle today, about $200. Excellent, excellent trade. Glockenspiel for us. But the point is, when a trade goes against you, you want to figure out how can you wrestle with that trade? How can you not lock in a big fat loser, especially if you still like the company? Because plenty of times, a name like Oracle, it's got a big beta to the market. A big beta just means that if the market's going to be down 10%, Oracle's going to be down too, because it has systematic risk. Beta is your systematic risk. So when the market pulls back, really good companies are pulling back as well, and you can get a chance to get long. That's what we did with Oracle. We did this with one more name that we have. We sold a lot more calls with this name, but I want to show you the exact type of trade. ARM. ARM 8/12/8/14 2024. So again, 8/14, getting in at 127. So probably about like right here. Okay? Bullish ARM. But in order to stay bullish, especially through this thing, we have to sell calls. So we've been selling the 185s, the 200s, the 200s, the 160s. So all of those selling up here, taking in income, because that allows us to stay in the trade and wait for that big move. So we originally get in at 127. Last trade is 145. So we have patience. We could stay in the trade, but by selling those upside calls, it lets us take in income and lowers our cost basis so we can more confidently stay in the trade, waiting for it to turn around. This is how we deal with our long-term holdings. It's a really, really smart way of trading, especially because when the market goes down, when ARM gets hit, volatility is exploding higher. So all those upside options are getting more expensive. So your long holdings, when volatility picks up, rather than stop yourself out, if you really like the company like we did with ARM or with Oracle, consider selling some of those upside calls to take in some income, and then you could stay in the trade a lot longer. Be careful though. You got to make sure that you love the stock in order to do this kind of trading, because if it's a speculative name like Enron, it could end up going to zero. Okay? Livy, good question. At what point do you close the calls that were sold? So if you'll notice, they're all expiring worthless. We're holding until they expire worthless, and then we just move on. And then, right, and if ARM drops again, we would just do the same trades over and over and over. Yeah, it's a really smart way, guys, to get that cost basis down. I want to come back to here. If you haven't yet watched this video, guys, go ahead, watch it at masterthantrading.com/challenge 2025. And then included with that is you get access to our Discord community where we're in throughout the entire trading day. Okay? That's what I got for you today. Great trade in Oracle, patience in ARM. This market is strong, right? They tried to break the market overnight. They couldn't really break the market. When the market is strong, if they can't take it down, we're probably going higher. Guys, thanks so much for watching. Everybody in All Access, you guys sit tight. We'll be right back.